The Fed15 podcast is presented by Serving Those Who Serve, a financial planning practice serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of either Raymond James or Serving Those Who Serve. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc.
Welcome to the Fed15 podcast presented by Serving Those Who Serve. Each week, we discuss the latest news info the feds need to know in 15 minutes or less. So whether you are a seasoned or federal employee or just starting out in your career, we have you covered. So grab your coffee, your energy juice, your green drink, whatever it is that gets you rolling. And we will tell you what you need to know but might have missed. We're your host. I'm Dan Sipe, and I am joined by the irrepressible and inimitable Katelyn Murray.
Absolutely. How we doing this week, Dan?
By the time people are watching this, it'll be past Memorial Day. So break out your shorts, break out your flip-flops. You can wear white.
I was going to say, get that white out.
You can wear your white jackets and stuff like that. I know this has been a slow roll into spring. That's it. Declaring it now. Summer is happening. It's done. Let's roll.
Oh, yeah. No, I'm harvesting spinach and romaine. It's spring. It's springtime. It's early season.
I'm jumping right into summer, Katelyn. Just, my patience is gone. Now, don't forget, I did battle with the groundhog. I ordered my mulch early and got a little bit of a warming trend, and then the hog came back with a vengeance. But that's it. Hog, you're done. Stay in the hole, get out of the hole. I don't care. Summertime.
Love it.
Time for graduation parties, proms, you name it. Summer.
For sure. Yeah. I'm all for it. I'm definitely a warm weather person, more than a cold weather person. I think winter's cool for like the month of December. Like I'm cool with getting a little bit of fall energy and like having the Thanksgiving meal. And then we can do Christmas, have a little hot chocolate with some peppermint, and then we could jump right back to warm weather as far as I'm concerned. But
I'm there for it.
So we have a couple of really interesting topics that we're going to talk about this episode. We're going to talk about one of my favorite topics, which is tax diversification. And then a little later on, Dan is going to talk with us about long-term care costs. And it just can't be understated. I mean, I know it's not something that any of us want to have to think about, but I promise you, the earlier that you think about it and start planning for it, the better your outcomes are going to be. And I'm not talking financial market outcomes. I'm talking quality of life outcomes, choices, where you want to be, where you want to age. So, but before we get there, I want to talk a little bit about something that can kind of help fund some of those long-term care expenses. And that is, tax diversification, right? Tax diversification is one of those things that you hear people drop as a buzzword term more and more. But I think it's one of those things that is referenced a lot that people don't actually understand. Like real people who need to do this sort of work.
Very true.
Don't quite have a concrete concept of what it is, right? So when we talk about tax diversification, and I'm going to do a lot of simplifying because this is a 15-minute-ish podcast. But when we talk about tax diversification, one way to approach it is kind of this 3-bucket strategy, right? Where I always say, the best portfolios that we see, what I love to see in a healthy portfolio is some tax diversification in the form of, we got a tax-free bucket, which is your Roth. We got a pre-tax or tax-deferred bucket, which is your pre-tax TSP or pre-tax IRA, right? Traditional IRA called a lot of the time. And then we've got a third bucket, which is your taxable money or brokerage money. And those are kind of the 3 main structures. And what I love about having those 3 buckets in your portfolio is you've got everything, right? A lot of people think that tax management is just paying a ton of taxes up front to put everything in Roth. Not necessarily the case, right? Because then you're all in on Roth. And if you have any periods in retirement where your taxes were lower than they were when you were working, well, then you paid too much in taxes when you prepaid, right? So Roth is not the be all end all answer for everybody, but what I think could be helpful for most people, at least, is having those 3 buckets. So let's go over how those buckets are taxed. So your bucket number 1, where I like to start, is that pre-tax bucket, because that's for most feds the largest bucket that we have. Why? Because TSP largely focused on pre-tax or traditional retirement savings up until the early 2000s. Roth wasn't even an option for some of you for a significant portion of your career. Okay. So that pre-tax bucket is, like I said, your traditional TSP contributions, your traditional IRAs. Okay. Your contributions there, taxes are all about when money goes through the tax loop. Okay. Because in most cases, with very few exceptions, HSA, you have to send that money through the income tax loop at some point. All right. So in the traditional side and the tax-deferred side, you don't send that money through the income tax loop when you make the contribution to the TSP or the IRA. You put it in pre-tax. That's why we call it pre-tax, right? And then it grows in that account. And when you pull the money out, every dollar is taxed as ordinary income at your income tax rate when you pull it out. Now, the pro here is that traditional TSP contributions are going to take a smaller bite out of your paycheck. The con is we don't exactly know what your income tax rate's going to be in retirement, right? And a lot of people say, I'm going to retire and I'm going to stop spending money. That's not really how it goes. And that sounds like a pretty boring retirement. The other factor, though, you aren't the only thing. How much money you spend is not what controls your tax rate. It's not the only thing that controls your tax rate, rather. The government at any time can change what tax rates are. We saw this with TCJA in 2018. The 25% tax rate became the 22% tax rate. The 28% tax rate became the 24% tax rate. If you had paid everything into Roth and you were retired, you were probably pretty mad because that meant you paid taxes at a higher rate than you needed to, right? So by that same token, though, tax rates can also increase, right? So the tax brackets that we're dealing with now while you're working, not necessarily what you'll be dealing with in retirement. That's another great reason for that tax diversification. So tax-deferred bucket, we don't pay taxes on the way in. We pay taxes as income on the way out. The tax-free bucket is the inverse of that. So when you're funding your Roth TSP or your Roth IRA, you are putting the money in after tax. You send that money through the income tax loop on its way in, it gets invested, and then it grows tax-free. And if you make your withdrawals appropriately, you pull the money out tax-free, right? Your principal, you already paid taxes on, and the growth is tax-free because that's how the Roth works. All right. So that's a great situation if you're in a lower income tax bracket now while you're working, and you expect that you may be in a higher income tax bracket, at least for some part of your retirement period in the future. All right. Like, I don't know, if you're in a situation where you're working and saving to your accounts in a time when we have historically low tax brackets, that might be a situation where where Roth might be a good idea because you're in those historically low tax brackets. Spoiler alert, that's right now. Okay. So that's your Roth bucket. Taxed it on the way in, no tax when you pull it out. The third bucket, and this is the bucket that I feel like people miss, right? Because Roth has been around now for a while, and we have a lot of feds that are looking at funding Roth that have kind of started, moving in that direction. The third bucket is your taxable bucket, your brokerage bucket. All right. Now, that is the non-retirement assets, okay? And a lot of people look at this differently. A lot of people include like pensions, Social Security, things like that. I'm not going to overcomplicate it. We're looking at this as an investment portfolio examination. This is your individual brokerage account that is not retirement-based, that is just, I tell people it's like a bank account for investing, right? It's opened in your name or your name and your spouse's name if you've got a joint account. You invest money, it grows. And the way the tax on that works is you're investing after tax money because you're investing money that you've already paid income tax on, right? When it goes into the brokerage account, the growth on those funds is taxable to you, but it is taxed as capital gain. And capital gain for most people is going to be taxed, long-term capital gain is going to be taxed at about 15%, okay? Flat rate. Lower for most people that are kind of for most people that we talk with, It's going to be slightly lower than your effective tax rate. All right. But that does vary depending on your income and what your situation's like. But for most people that are in that 22 to 24% tax bracket federally, it's going to be slightly lower than your effective tax rate, your blended tax rate, if you will. So why I like brokerage accounts are, it is not taxed as income. It does not increase your income. It is taxed as capital gain, and that gives you some fluidity when it comes to taxes. For example, if I'm wanting to fill up my current tax bracket, I can pull out of my tax-deferred bucket up to the top of that tax bracket, and then if I need more money, I can look towards my brokerage account, pull that out, get taxed as capital gain, and not increase that income. All right? So really, really good to have all three buckets. You should be shooting for having all three buckets. All three buckets provide you with the maximum amount of flexibility, which is really what you want. Flexibility can equal reduced tax liability, can equal you get to spend more of your money instead of giving it to the government. Can also mean that your beneficiaries get to keep more of your money than they would otherwise if they're giving most of it up in taxes. Okay. So hit the website for a little more detail on this article. I don't want to go super into the weeds today, but the core of it is that 3 tax bucket retirement strategy, having all 3 of those buckets. If you're missing one, or if this kind of went over your head, but it sounds like an important thing that you should know more about, feel free to reach out to us at meetings@stwserve.com. We're happy to sit down with you, explain it, help you on your journey if you want that help, or we're happy to just educate. That's the great thing about a purpose-led practice is we can spend that time just educating. So speaking of education, Dan, tell us about something that we could all use a little more clarity on. Long-term care costs and how to manage that.
Yeah, here comes the old guy sucking the fun out of everything. Okay, so Katelyn was just humming along there, and you do this with tax diversification, and that kind of turbocharges everything. That's fantastic. And now I am the wet blanket. Here's the thing. Don't let the baby face fool you, folks. My next birthday will begin with a 7. So I'm thinking about this stuff. I don't like it, but I'm thinking about it. And more than anything else, when you reach a certain age, you need to start having a plan for this. It is absolutely vital. So, high level here, I think most of the folks who are worrying about long-term care kind of know what it is. I'm reaching out to the folks who maybe have been telling themselves to think about other things and maybe aren't worrying. I'm not saying worrying, but be mindful. So long-term care frequently begins with some home assistance that may progress to assisted living and then ultimately skilled nursing care. But the big thing here is there are situations where it can become the largest unexpected retirement expense for feds. And I'm sorry, it shouldn't be unexpected. I'm going to be a real downer here. Okay. Expect it to happen to you and then rejoice when it doesn't. Okay. So even strong pension and TSP balances can be strained and overextended from this because federal long-term care insurance partners, they're on hiatus right now, but they've been kicking out great data for a long time. They did a survey that indicated, and this is average across the nation, your area may vary, home care about $51,000 a year, assisted living about $66,000 a year, and then that skilled nursing care and nursing home, $112,000 a year. That's a lot. And yes, you might have cash flows coming in from pension and Social Security and TSP. But if one of you is staying in the house and the other's going into a situation where there's custodial care, that can really strike a blow to what you worked so hard to build. And please, 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 please stop telling yourself when you're going to die. Don't do it. Stop doing it because you don't know. You really don't. And, all too many times, I won't last that long. See, here's the thing. I'm a fiduciary. I gotta talk about that you will. So let's touch very quickly. Where do long-term care insurance partners stand right now? They're still on hiatus, hopefully coming back in December, actually November, December. It's a great program. Okay. But even it would not do everything for you. So the way people typically fund long-term care, self-insure through savings and assets, long-term care insurance, whether it's through partners or someplace else, hybrid insurance products, you want to be careful there. all that glitters isn't gold. Well, I got this and it says it'll do that for me. Make sure somebody who understands, independently of the person who brought it to you, who understands long-term care insurance vehicles and insurance vehicles in general, reviews that with you to, in plain language, tell you how it's going to work. And then the last one, and boy, do I hate it when people try and cook this in as normal. Yes, Medicaid can help cover long-term care expenses after you've exhausted all your assets. And I meet people at least once a year that are doing trust work so they can qualify for Medicaid. You don't want to be in a Medicaid care situation, folks. You just don't. That's plain talk. Send me the hate mail. Tell me I'm stupid. Okay, I have walked this walk. I have walked this walk with my family. I've walked this walk with my friends. You want to have the best care situation that you are able to get. Okay, so let's talk about that. Self-insurance tends to work with folks who have a strong savings habit and some flexible cash flow. That might be, that might not be you, or you may be able to start building those habits. Insurance availability and affordability vary. There's not a lot of long-term care companies anymore. There are a couple out there. And again, now we've got these hybrid things that are coming in, and you want to make sure you really understand them and somebody's reviewing it besides the person who is setting it up for you. And at the end of the day, most households combine multiple strategies. The one thing that gets missed, number one provider of long-term care is spouse first, number one, and you need to have some plans around that. If somebody's going to be assisting, and believe me, if something happens with Miss Mary, I'm going to be there. Okay. You're not going to see me as much. There might be more guest hosts if that happens. But then I'm going to have plans for how I can do that. Okay. So don't automatically exclude that. That's not in the article. I'm throwing that in because, again, I've walked this walk. So how to get an estimate. Okay. You need to project yourself forward and think about things you don't want to think about. So you want to think about home care. Who can I bring in that might help me with this and that and something else? Is there a place where we might look to progress to assisted living? And then what's happened within our family? Look at your own family history, not a bad proxy. And here's the thing. I have done all my planning like I'm going to go first. And Miss Mary's going to be taken care of. Hey, let me tell you something. I got 3 aunts that made it to 101. Okay. I might be the one that goes the distance. So build that in. So never consider that long-term care is going to be shorter than 2 to 4 years. Never, never, never. Now, it may not be a whole heck of a lot longer because it just depends on your state of health when you go in. Okay. And then compare those costs against the savings that you've put aside, the insurance coverage you may have, reliable family support. And the difference between the projected cost and your resources, that's your long-term care funding gap. So practical things you can do. Okay, Dan, you've dumped all this stuff on it. You have wrecked my day. Thank you. What can you actually do? Start to take a look at those fixed expenses or where you can reduce them wherever possible. I don't want to chase people out of their comfortable living situation, but take a look at what it costs to live in your home. Okay. High housing costs, debt can make long-term care harder to absorb. Dan, I can't work one more day. I hear that a lot, Katelyn. I know you do. And we have to kind of talk people down off the ledge and say, maybe you want to get to this age and here's what you can do in the interim. So getting rid of debt along the way puts you in a better position to be more resilient. And I would also recommend that as we age, we want emergency funds. You want to start seeing some of the savings you're putting aside as care for that type of emergency, and discuss future care and coordinations with family early. Do it. Bring them in. Nobody wants to be a burden to their kids. Okay. I got great kids. I can tell you right now, no, Colin has said, Dad, I'll take care of Mom. You can count on me. I'll be there. Old man, you're going in the home. And so now we barter, like I'll do nice things for him. I go, okay, that gets you one more visit, Pops. But no, we've had this conversation. Yes, we joke about it, and SIPs do play a little bit rough, but we're having those conversations. So mistakes to avoid. Do not assume Medicare is part of this. Not. And if you are not attending our FDHB, Medicare, and TRICARE, do it, and you'll hear that. Okay? Don't wait too long to look into things like insurance. If it's out there, the younger you are, lower it's going to be. And don't sit here and say long-term care partners are coming back at the end of the year. They might not. So, and avoiding these types of mistakes can improve your flexibility and your planning control. Okay. Build a plan before you need it. Okay. If care becomes necessary, where am I going to go first? Where am I going to go second? Where am I going to go third? Review those resources and project realistically. Okay. And potential actions. Okay. I know that reducing expenses and putting money aside, that's as popular as diet conversations, but it's important. Okay. So increase savings, look into insurance, be realistic about your retirement spending plans. The planning doesn't need to be perfect, but it needs to be done and it needs to be intentional. I'm pleading for your future self, and I'm pleading for your future self that might not be as capable as you are right now. So put a little bit of time on it. Yes, I have just ruined this whole podcast because Katelyn was talking about great things about how to do better stuff with taxes, and then I sucked it all out of the room. But please, please, please put some time in on this. That's what I got,
Absolutely.
Katelyn.
Yeah. And I mean, it's not the best thing about financial planning is that kind of the fun part is that everything is interconnected, right? So with the savings that you create through a dedicated tax diversification strategy over 10, 20, 30 plus years, with those tax savings, you can then afford to fund more long-term care.
Absolutely.
So, all of it kind of really does pull in the same direction. So with that is all of the time that we have for today, folks.
No, I don't want to go.
We got to. They're going to start Oscars playing us off if we don't. But we will be back next week. Unlike the Oscars, you don't have to wait a whole year. Next week, we'll be back to bring you the latest updates and news and tips and tricks and financial education that you need to make informed decisions about your career and your financial well-being as a vet, whether you're retired or not.
Absolutely. And hit that subscribe button. Okay. You've ticked up. We're watching the stats. So we've been begging. And by golly, you've done it. Please be sure to subscribe to this podcast on YouTube and Spotify so you never miss an episode. And please remember to share it with friends and colleagues. We're doing our best to get the stuff out there that matters. Please help us get it out.
Absolutely. Now, for more information on the topics that we covered in today's show and more, be sure to check out our blog at stwserve.com. You'll find great articles written by Mr. Ed Zerndorfer, the federal benefits guru. You will also find articles written by our team on topics that we are seeing in our meetings with thousands of feds that really, really matter and impact your bottom line. While you're there, you can subscribe to our newsletter, The Weekly Serving, to get all the latest news for feds delivered straight to your inbox every single week so that you don't have to go looking for it because it's difficult to make time in the day to go hunting. So don't hunt. Let us just send it right to you so that it's right there in your inbox when you need it.
Absolutely. And don't forget about our webinars, our live webinars that we do pretty much every single week. We've got a couple of dandy ones coming up on June the 2nd. From 11 till 2, we have financial planning with the one and only Katelyn Murray. You don't want to miss it. It is crackerjack. Don't miss this and bring some friends. But also, and I know this sounds crazy to be talking about this, in June on the 10th from 10:30 to 2:30, we've got FEHB, Medicare, and TRICARE. What did I tell you? If you haven't done it, go see this. That's where it's going to tell you, no, Medicare won't do that. But also, get a little runway set up for yourself for open season so that you're making the best decisions going forward. There are a lot of things that are being built into FEHB every single year, and you need to stay up on that. And if you prefer a personal approach, I want somebody to just explain this stuff. Hit us up at meetings@stwserve.com, and we will sit with you and help you understand this and get you moving in the right direction. We call that part 2 because everything else is part 1. You went to one of our webinars, that's part 1. You went to one of their webinars, those 1-hour ones that cover everything because they're so amazing. They have genies or something. if you have some questions after that, can't imagine why you would, because they can cover everything in an hour. Part two makes everything better.
All right. Well, thanks so much for listening to the Fed 15. I'm Katelyn Murray.
And I am a very energized Dan Sipe.
He had he had both his green juice and his energy drink this morning, folks. So he's ready to conquer the day. And we will see you next week on a brand new episode of the Fed 15.